All right, welcome back. All eyes on the U.S. economy and a lot to digest. So joining us to talk about it is Dr. Alex Tyson, who is an economics professor at Grand Canyon University. Great to talk to you again.
Great to talk to you again, Mike.
So let's start with the big news this week. The Fed is cutting interest rates 25 basis points. So they're finally starting to cut rates. Practically, what does that mean for the everyday consumer?
Well, I think as I said the last time I came in to talk about this, with things like interest rates, a lot of this has already been priced in. Markets had already been expecting a rate cut. Question was really more, would they be sticking with the expected rate cut of 25 basis points, which is what they actually did today, or were they going to go on the stronger and more aggressive end, as was advocated by our the newest member of the Fed board, Stephen Moran. But it looks like the Fed is opting for the more cautious middle-of-the-road take of a 25 basis point cut with projections for more cuts going forward for the rest of the year as well.
So in hopes here for businesses that borrow money or use lines of credit to grow or to exist, this is a little bit of relief for them. Does it send the message it's time to buy that equipment, it's time to hire people? Is that the message they're trying to send?
Well, that's absolutely the hope, right? And I think the motivating factor here was that we have seen some troubling signs of some slowdowns in certain sectors in terms of hiring. And so I think that giving a little bit of relief on the borrowing cost side will definitely help businesses who are maybe, again, on that margin, wondering about whether or not to expand or not. Now, again, this cut of 25 basis points was already essentially priced in. I think the thing that businesses are really going to be looking forward to is the prospect of future relief going forward, and the fact that this is sending a signal that policymakers do see that there is a need for some of that relief for businesses who are feeling pressured.
So when you factor in taking the politics out of inflation and tariffs, but just the raw numbers, 2.9% on inflation, we see wage growth is doing fairly well. Are we worried? How concerned are you in this world of a bit of a bounce back in inflation because the rates went down?
I think at this point, that's probably not the main concern. I think in part of the issue that I think the Fed is now responding to is trying to disentangle the extent to which that lingering inflation is due to effects like the tariffs, which is something that one would expect to have a temporary effect on inflation, but not a permanent effect. And so I think a large part of some of the issue that we're going to be facing going forward is disentangling this issue of what inflation is due to excessive demand and what inflation is due to some of these more transitory cost pressures that we should expect to go away after a short amount of time.
All right, and so you talked about the job market, and people are a little bit concerned. The numbers are concerning of the slowdown, but consumer spending in July was adjusted up to 0.6%. Consumer spending in August came in higher than expected at 0.6%. So the American consumer seems to continue to spend. Is that a good thing?
In part, this might just be this might just be a continuation of trends we've been seeing for the last several years. One thing that's been pretty surprising, actually, as we've had other ups and downs in other areas of the economy, the American consumer has just kept on keeping on. Part of that might be them being the American consumer feeling pressured. Part of that might be due to just, again, people, when surveyed, often say that they feel that their own personal economic situation is fine, even if they don't feel great about the job market more broadly or the economy more broadly. So part of what we may be seeing is just a general optimism on the part of typical consumers, and part of it might also be consumers feeling the need to stretch a little bit. And if it's more the latter, that is something we should probably be concerned about. And that should be something that this relief on borrowing costs should probably help with as well.
The PPI numbers came in a little bit better than expected, which means the producer price index wasn't as high as people thought. Does that mean we're going to see lower inflation next month, or is that what it lends itself to?
Typically it does. Again, I think right now we do have a little bit more noise in that data than we usually do, just because we are in such a fluid situation with tariffs especially, but other cost sources as well, such as energy. So I think, again, taken on its own, that is a positive indicator for inflation. Again, an indicator that we should probably be expecting more easing on interest rates as we go forward.
Dr. Tyson, as always, love the expertise and the information.
All right. Thank you so much. Great to be here, Mike.
We'll be back.